All right. And so we have John Gavin on the call. If you guys don't know who John is, and I'm super thankful for the relationship and how natural it's actually came about for us. But John is an integrity partner, obviously, as you guys just saw. But above all else, he's just makes everything so darn simple. To me, it's almost just like when you call your dad and he's got something going on. You're gonna be you want things simple and simplified for you. I feel like sometimes when I call someone about these specific products, they want to be like, hey, I know a little bit more than you on this and that. And it's different than like when you call, like I was just saying, when you reach out to your dad about something and he's just going to say, hey, look, this is what you need to know. And so that way you can help them do this. And that's exactly why I wanted to have John on the call. But if you didn't know, and this is just for you guys on that are here and anybody that watches this again, John wrote the very first annuity with Family First Life. I think he oversees his book of business that him and his agents have been able to write. And so, I mean, I heard it the other day. It's like over 100 million in assets that you guys have seen. And so that just means like the confidence that comes from having seen that, like how much I just know about life insurance. Like I feel like I stumbled into it from seeing you guys like sell and all the questions you guys asked me. I'm like, no, I know. Like COPD does not get the IUL. Like it just doesn't happen. Like I just seen it so many times. John has seen that in the annuity side. And so that is like honestly a blessing to have John with us. John, man, I want to introduce you to us, and thanks for taking the time tonight. You've been with us all week.
You bet, you bet. And it's cool. It's kind of cool that we're both still in the business because you look back at those early days, there's so many people that have come and gone, and to me, it's crazy that some of the people that bailed out of the business because they had a bad day or a bad week, and if they just would have hung on a little bit longer, that the industry changed, our business changed, things got better, things got easier, and who knows where they'd be today if they just would have stuck it out another week and not quit. It's
Huge.
crazy.
It's huge.
So yeah, we've got for annuity side, we've got about 137 million in our book of business. So I have seen a lot over the years. And like you said, my whole approach is one of simplicity, and there's a few reasons for that. The biggest one being I'm not that smart. So when I tried to take, I was fortunate enough to work with Sean Ruggiero, who's one of the smartest people that have ever walked the earth. His style is just a little bit different than mine. And when I first started out, he gave me all this information, and we were with a previous company, and I wanted to sell annuities because I was broke. And I figured I saw some checks and deposits that people were getting from annuities, and I was like, that would help me out a lot, So I dove right into it, and I overcomplicated everything. I took so much information, and I tried to give it all to clients, and what I didn't understand, they didn't make sense to them, and there were 9 horrible appointments, and so I knew I had to change something, and I changed it to stop trying to sell annuities and understanding what the client's needs or concerns are. The biggest thing is concerns. Understanding what those were, and I can look back at what products I have and show them how to eliminate those concerns, and I started closing them, and I've kind of kept that same approach ever since.
Yeah, and John, one thing I notice is you do like that, and I think it's something obviously in success, people that become confident like with what they do, you're good at making fun of yourself in a sense. You know what I mean? Like how you say, I'm not that smart. You want to bring that out. How much does that help you? Because I feel like it actually helps a lot. Like when I was in that meeting, we set you up, and just recently catch anyone up. What John does just to lay the table down. Anybody here that has any client that has an annuity, right, or has a 401k or has floating, money that needs help, they don't know what to do with the money. John will help set them up with the annuity, and you'll do a 50-50 split, do all the work for you, right? So we just had that happen. And so now to track in, I just saw you do it. And I was like, dude, I was like, man, I was like, how do I make fun of myself? But then at the same time, become a professional at the same time. Like it's a
Yeah,
trick to it,
yeah.
And is that something that you kind of over time, or is it too complicated? Because it almost does the reverse effect, but then it makes it level with the client really well.
So that's actually a really, really good point. And I think the point of that is you have to be yourself. So if you try and be somebody or not, like one of the things that we want to discuss here is how to get trust from your clients. And one of them, a quick way to lose trust is to talk about something that you're not sure of. So if you're presenting life insurance, annuity, whatever it might be to a client, and you don't believe in it, they can smell it out. And getting back to my self-deprecating humor is I've always kind of done that a little bit, but I actually have a lot of confidence, a lot of self-worth, and a lot of pride. I do it in a certain way, and it's just always been who I am. If it's not you, don't try to make it you. But if you have a sense of humor, let that side out. Because if you think that you have to be, I'm a professional, I'm a financial professional, I have to present this annuity and I have to act like this to gain their trust. If you're trying to act like somebody else, whether it's too smart, too dumb, or whatever it might be, you're not being yourself and they can see that. So my best suggestion to you is when you're doing a presentation, be who you are, but do it in the best interest of them. You can be self-deprecating. You can make a couple jokes of yourself. You don't want to go overboard on it, but it just kind of makes them think that you're a real person, you know. But if it's not you and you've never done that before, don't start now because it could
Right.
backfire on you, you know. Just be who you are, but do it in the best interest of them, and I think you'll have a lot of success there. And I think that's the best way to gain trust. Don't
Definitely.
talk about things you're unsure of. Be who you are, and genuinely try and get an understanding of where they are at and what position they're in and present that way. Because if you don't have a full understanding of where they're at and what they're looking for, you might be trying to sell a Honda to somebody who wants a Lexus. And you've got to find out what they're looking for. And there's times I say to people, you know, our products, our retirement products are conservatively based. We're not going to lose any money, right? They're not for everybody. They're not meant for the day traders that like the excitement of, you know, their money looking like an EKG every week. They're not meant for people who like to take out more than 10% per year. And so when I started knocking out those questions, I said, well, if you like to not lose money in the market, you like to get a bonus, you like to get some safe growth, it might be for you. And so then I find out what exactly they're looking for. I've had people say, I'm trying to get the highest rate of return possible. I don't care what it's in. And I'll say, great, that's not our product. Sometimes when I explain what our product actually does, it pulls them back in and they reevaluate, say, I'm actually not trying to get the highest rate of return. I'm trying to get a return that I can maximize my retirement, not lose any money, and gain over time. So sometimes they shift that. You've just got to ask the right questions in a really sincere type of way to find out what it is they're looking for. You know, the situation
Definitely.
that we had there, you know, first started the conversation off, they're going to sell a house in a couple of years. They're planners. Like they want to know, we're selling this house in 2 to 3 years. What should we do with it? And I'm like, I don't know. I don't know what the market's going to be 2 to 3 years from now. So I can't even project that way, but let's look at this stuff here. And so we generated enough interest off their current accounts that we're looking at moving those. And then at the end, I said, I can give you an idea of what it's going to look like in a couple of years from now, but I can't give you ideally because I don't know what the environment's going to be and what the markets are going to do. And so it's just being genuine and finding out what they're trying to do and addressing their concerns, their fears, or whatever it might be.
Definitely. And I'm going to bring us back so we can have like a progress of how we're going to take the call, guys. I put it in the chat here, and we're already kind of getting into it. But everything that John is saying, literally, I would just say, and that's why I said you can make fun of yourself. It's actually the way you did it was so easy to do so that it puts you in the power position. I think it's a very duplicatable approach how you do your IU or your annuities. Now the structure of how it went right is in the chat, but it went inventory was the very first thing. And we're kind of doing that now. You know, they wanted to sell a home. They're planners. And I think genuinely, we're not going to train on inventory. I'll just touch on that right now because when we do life side, we should have a general inventory. And when you connect with John, he's going to do the inventory even deeper. And the more we have information for him to say, hey, John, they have houses. This is his, you know, their plan for this, and that, the better. And then he's going to genuinely do it. Each inventory is going to be different. But after that, and we're going to cover these next steps more particularly with John here. But then we're going to go into how he develops his trust because that's huge, right? We weren't there as a life insurance agent. And the way he did it is actually eliminating CPAs and so forth. But the second step is trust. So just how we have 9 steps inside of a life insurance sale, first step was inventory, find the money. Second step was, and this is from me just seeing it literally yesterday or the other day, is then trust, making sure that they trust you because they can't get this product from anybody else. Have John explain that. After that, he then goes into the actual benefits. We might have him share the screen here really quick. So we'll buzz right through it. After he gets the benefits, they're like, oh my God, I really like it. Then you talk on why now. So we're going to cover why now. And then at the very end, you're basically showing results from other people, which now just shows proof of concept of like, okay, how much am I going to put into this? And so that's what we're going to cover here in the next basically like, 20, 30 minutes. It's those 5 steps. And just like how we do in the life sales, we're going to keep going. So that's inventory. You figure out where's the money, what is their goal. And then John, after we have now, someone interested in the annuity, but they're generally, looking, I have money, but I haven't planned my retirement, glide
Yeah.
strategy. How are we? Let's go over trust. And so, for someone trying to make a client trust them into now a future annuity sale for the future, how are you doing that? So that way, because you already know what to expect, and that's what you were teeing up. When you're building trust there, how you going?
Yeah. So and we can refer back to the meeting that we had yesterday, and I can utilize a time when I actually failed, because I use a time where I failed to build trust in order to build trust with them. And so I had met with somebody a few weeks ago. I've got a 150-pound mastiff that's drinking water right now, so literally he's done. Okay. All right.
I think I've met him too.
So I was yeah. So I was driving over to meet with this couple, and I got a text from somebody that said, "Hey, John," and this was somebody I'd met with a few weeks before. Said, "Appreciate your time. I talked to my advisor, and he can do that. He said he can do the same for me, so I'm going to stick with him." Right. And so I was telling the client this, the client we actually met with, and I said to them, I said, "Yeah." So I got this text on the way over here from somebody I've met with previously. Said they're going to stick with their advisor. You can do the same. Thanks for your time. And I said immediately the thing that I realized is I failed to build trust there, because that's a trust factor. They didn't trust me and the product that I presented, so they went back to their financial advisor and said, "Hey, I talked to this guy. He showed me this. What can you do?" And his financial advisor said, "Oh yeah, we can do the same thing here." And I said, I failed them because I didn't build enough trust where they actually decided to work with me. They went back to their financial advisor, who was letting their money just sit. This guy was 77 years old. Their advisor is letting them sit with money completely at risk. If the market were to lose 30%, the 77-year-old is going to lose 30% of his retirement. But he didn't trust me enough. I didn't build that in him. So he went back to him. And then I told the clients we met with, I said, what this guy doesn't realize is that he can't do the same thing. That in order to do the retirement products that we have here, that eliminates all the risk, has little or no fees, has a bonus attached to it, and still gets a pretty good return, you have to have your insurance license, because your advisors don't have it, your banker doesn't have it, your brother doesn't have it, nobody has it unless they actually have their insurance license. So this client that sent me this text obviously didn't understand that. And so in a casual conversation or casual atmosphere, I'm just kind of letting them know, talking indirectly to them about somebody else, saying he doesn't understand that their advisor can't do this. I'm actually talking to them and letting them know by using somebody else. It was, and it actually did happen. So I don't make anything up. Everything I say is true. The guy did text me. He didn't understand, but I utilized that to let them know that if at the end of this, if you want to go talk to your advisor, he can't do the same thing we just talked about right now. And this is how I'm letting you know by talking about a different situation that I had to deal with.
Yeah. And that was really good, guys. And honestly, it wasn't even that crazy sexy what John is saying. It was just like an example, a story of building trust. The biggest key, guys, is you do it early on is how I saw the positioning. Because
Yeah.
now as you keep going through the conversation, remember, they don't even have that product, guys. So as you're thinking about a safer investment, they don't even have that option, but you can go in that, you're not competing with them. That was really great. And then John, if you have the FIA, I think I have it right here on my email. But then the benefits, I think then you go into explaining benefits. You obviously at this point you would have an annuity from, either John or one of the specialists will send you the one, and there's a specific reason you're going to be showing the one that you're doing. But do you mind? Do you have an annuity you can show, or you want to just share
Yeah.
with us the main benefits and how you're
Yeah.
basically?
Let me pull that up real quick. Hold on. I'm going to block my screen out just real quick. Hold on one second. Okay.
Yeah, no worries. And when he did this, guys, it was like you guys have seen Tyler sell insurance, right? Like he just says it on repeat. I was looking at John as he's doing it. I was like, I feel like I just saw him do it on a training, and then now he's in our office saying the same thing he just said in the training, just again. And he's just about, and I was like, let's just get it recorded. And I did record the one that we had with the clients, but I don't want to expose them like that. It's their situation. That's why I want to have it here. So, John, I'm excited for this. And I would take a lot of notes on this. It's literally on repeat. Like it's just
Mm. So you just want me to go
and
over the illustration? Is that it?
Yeah, yeah. So now you at this point, guys, you got the inventory. Like Haley, you found money. Tyler, you found money. Awesome. Now let me show you why you should trust me. I did really bad. You say a story. Other people don't even have this product. So now I got to get an illustration. This is how John shows it. And I feel like if we just repeat this video and watch it over and over again, bring it to a point where we can do this as well. No doubt.
Yeah, anybody can do this. I'm telling you. Let me just pull this up. All right. Here we go. And where we All right. Can you guys see that?
Yep.
All right. So this is verbatim how I go over an illustration. Now, in order to get to this point, obviously we've uncovered money. Obviously, we set an appointment. We know what their goals are. Now, this is for someone who wants to safely grow their money. Okay. This is and I'll talk to you guys like I'm talking to a client. And a lot of the stuff I do is just really low key, nonchalant. I don't overblow everything. I found out they don't like to lose any money, but I'll let them know. Okay, so this is going to be an illustration from a company called Athene. You may not have heard about them, but they are number one in their space based off of volume. Highest producer of fixed index annuities in the US. They've got about $250 billion in assets, and they're also A plus rated by all the companies that rate the financial strength of insurance companies. Okay, so that way I'm giving a little bit of a background on their financial strength. You may not have heard them. They don't have commercials. They don't have blimps. They don't have stadiums. They have agents like me that go out there and bring their business, and it's working really well for them because they are number one in the country for fixed index annuities. Okay, this product here, it says here, and here's the thing about when you guys start presenting, and my goal, like what Diego was saying is like, if you bring stuff to me and I do it all, I'll do a 50-50 split with you. My goal is not to do that more than once or twice. My goal is to get you up and running so you're doing it on your own after a time or two, and then training others to do the same. So this is not me trying to build a business up by getting half the commissions from people. My goal is to teach you, be a resource for life, and get you guys up and going. Show a simple way to do this where you can actually do it yourself. So here, Athene basically spells out what this is. So as Athene Performance Elite fixed index annuity might be right for you if you want one or some of the following. Guarantees. So you can exchange a lump sum of money, whether it's an IRA, 401k, or money from the sale of a house for a fixed rate under the guarantees. The fixed rate is not sexy. It's usually 1 to 3%, 1 to 2% maybe. I've got 137 million in my book of business, and I don't know that we have any fixed rates in there. There's just a lot better ways to generate interest from these products. But if somebody was really conservative, said, you know what, John, I don't want to lose any money. I don't care if I gain any. Put me in a fixed rate. And we'll do that for you. It just hasn't happened yet. Here is the growth potential, and this is how their assets can grow. So what they're going to do is Athene is going to apply interest on an annual basis based off of how certain indexes perform. Now, their money's not actually in that index. So if the index happens to go down, they're not going to lose any money. But when that index goes up, they're going to participate or get a portion of those gains applied to their account. The best part about it is once it's applied to the account, if that index goes down the next day, the next week, the next month, they don't lose any money. All the gains are what we call realized gains, which means they get to keep it. Okay. Um, it does come with a premium bonus that is based off of state, and I'll see what that is here in a minute. And here's a big thing: it has no downside risk in the market. So you've seen your 401k fluctuate a lot. You saw 17 years ago when the markets lost 17%, 21, 22, or 43%. In 21 and 22, the markets lost 18 to 22%. Our clients don't ever lose any money. Okay, so there's no direct downside market risk at all your gains are tax deferred, just like your traditional 401k. You're not taxed on it until you make those withdrawals. You can turn it into income at any time, so you can get a steady stream of income later on, either monthly or annually, however you want to take it. And I think this is really important here is the death benefit. The death benefit avoids probate. And the reason why that's so important is if you have somebody who's not married and they have money in a 401k, an IRA, stocks, bonds, checking, savings account, and they pass away, anybody can file probate on their account. That freezes all of their assets for 8 to 10 to 12 months, depending on the size of their estate. And the money that goes around that would be money in an annuity or life insurance. There's a named beneficiary. If somebody files probate and locks up all their other funds, the annuity would go directly to their named beneficiary and they'd get the money in 2 weeks rather than a year. So that's really important. Now here, so in this state here, the premium bonus is 18%. Okay. Now the bonuses are higher now than they've ever been. And there's a certain reason why, and it's because the environment or the market for fixed index annuities is better now than it's ever been. The indexes that make up the combined interest rate are all right here. I typically don't go too deep into those because it confuses people. And the way I describe this is if somebody came up to me and said, hey, John, do you want 2 cups of sugar, a cup of flour, a couple of eggs, and some vanilla extract? I'd say, no, that sounds disgusting. Why would I want that? Then if they came to that same person came to say, John, do you want some cake? I'm like, hell yeah. Chubby guys love cake. And so this here is the ingredients. This is the flour. This is the sugar. This is the
And
vanilla
John,
extract.
I'm just
Yeah.
going to stop that really quick because that example, I feel like you literally did that. So, guys, he's talking to us like he talks to the clients. He said, and I don't like to confuse you guys. Sometimes we say things, but you're like, oh, no, then they're going to ask me more questions. John's like, and honestly, you even said, now we could get into it, but do you get what I'm saying? So that is a really important point because you're covering it like in
Yeah.
your way of over blanking it, which is like what I get back to when I emphasize John is just keeping it really simple. And so I don't mean to interrupt, but that's
No,
just
you're
so
good.
you
No.
guys know that are watching it. I'm like, this is literally the repeat. You know what I mean? It's just over and over again. So yeah.
So I do give them the option, but most people just say, no, I don't want to know. So, okay, great. And I'm going to send you this so you can dive into this all you want on your own time. But just for time purposes, and you don't want to be bothered with all these details, I'll show you what the end result's going to be. Okay. And they say, great. So then I fast forward. This is a little bit more of the same. So I just kind of scroll through this. Um, and then here, so this we're looking at $500,000. So this is the guaranteed section here. Okay. The guaranteed section is not going to show any growth whatsoever because we can't guarantee that the market is going to grow. But what we can guarantee is the market is not going to lose. So $500,000 rolled into it, gets a $90,000 bonus attached to it on day one. So you're starting with $590,000. Do you know what the markets would have to get to in order for it to grow 18%? We're already in a place we've never gone before. So in order to hedge your bet on gaining 18%, you're putting a lot of money at risk. You don't have to hedge your bet. We'll apply it on day one, and it's also going to accumulate interest as well too. So this accumulated value here is simply the 590,000 you're starting off with, and there's only a 0.95% rider charge that's with this account. There's no hidden fees, no internal fees, no management fees. There's that 0.95% rider charge. And what you're getting for that charge is you're getting the increased bonus of $90,000, and you have increased what they call liquidity. So you can pull 10% of this account, the account value out per year, and after the fourth contract year, you can actually take the whole thing out if you wanted to and go home or take it someplace else if you chose to. Okay. So that's just not a fee that's just being charged to you. It's actually a rider charge that you're getting something for. You're getting increased bonus and increased access to your funds and the ability to move it out after the fourth year if you chose to. So here you're seeing just a natural drawdown of that 500,000 plus the 90 drawn down by 0.95% per year. And eventually it bottoms out at 536,000 because that rider charge falls off and it's not charged anymore. Nothing is charged. So if you brought over $500,000 and the market went down for 10 years straight, with us, you'd still come out ahead at 536,000. Okay. But this is showing no growth. The market's never not grown for 10 years and it's never gone down for 10 years. So let's look at something that's a little bit more realistic. And that's this. So here we have a projection. Like we don't know what's going to happen next week, next month, or next year. We don't know what's going to happen 10 years from now, but we do know what happened 10 years ago. And so what we look at is that combination that we looked at earlier of indexes, your 500,000, the bonus added to it, and the last 10 years actual returns based off of those indexes. And here's what you have. Last year would have been 6.9, the year before 9.5, 7.3. You have a big year of 19.27 here. So you see some consistent and some sizable growth. The best part about it is now you look at that accumulated value. Now you don't see a natural drawdown of that rider charge being subtracted from it. Now you see significant growth. So 10 years from now, that 500,000 deposited plus a bonus, 10 years from now, you're looking at 1.6 million. Now, will it look exactly like this? Absolutely not, because the previous 10 years are not going to repeat themselves for 10 years moving forward. But this gives you a good sample size of what's happened over the last 10 years. We saw some really good years of growth. Then we saw 2 years of a lot of losses. The good thing about our products, we don't spend any time recovering. So in 21 and 22, when the markets lost 18 to 22%, and anybody that had their money in the market was recovering in 2023, we were growing on top of that because we didn't suffer any losses. We're always compounding on the previous year's gains. We're not recovering from years of losses. Hopefully that makes sense.
Yeah.
And then after that, I fast forward to this section here. And I always tell people, I think personally, I think this is the most impactful page of the 25 that are here. So what we have here is we're going to look back 20 years and we're going to cut it into 10-year segments. The column on the left is the most recent 10 years. Those are the figures we just looked at. The column in the middle is the highest 10-year stretch we've had over the last 20 years. We're not even going to look at that. What I'm going to focus on here is the lowest 10-year stretch that we've had over the last 20 years. So what this is saying is that anybody who took $500,000, put it into this product with that combination of indexes, the worst they did was get a net return over 10 years of 8.73 or have a total account value of 1.362 million. So when you have something that has 0% chance of any losses whatsoever, we're going to give you 18% to start off. We're going to lower your fees because you've got some money in some mutual funds that are charging internal fees on top of what you're paying your broker. And the average rate of return, the worst case over a 10-year stretch, is still 8.73%. So a lot of my friends are financial advisors and they're great people. I ask them if they have anything to compete with this and they just don't. What they can try and do is build something internally that would act something like this with a combination of bonds and equities. But the bonds are limited with losses, but they're also limited with growth. The equity side of things, whatever they try and build, has the opportunity for a lot of growth, but that same opportunity for a lot of losses. What we have here in one product is what advisors would try and do, which all of our account is protected from losses, and all of our account has the ability to grow when the markets do go up. Does that make sense?
Right.
So that is actually almost all. I cover some of the surrender charges when I tell people that this isn't for people that want to take out more than 10 or 20%. I show them what the contract, what the surrender charges are. But we've already established that they have money outside of this and they're not going to be taking out more than 10%, or I wouldn't be showing them this because I eliminate that
Right.
up front, saying this isn't for people that are day traders that want to see the excitement of their market fluctuating or their account fluctuating throughout the year. And it's not meant for people who want to take out more than 10%. So I'm sitting here with only people who do not need more than 10%, but I'd let them know that if you need to, it's available. You're just going to get a little bit of a surrender charge on the amount above that 10 or 20% that you need or take out.
Right.
Does that make sense?
Right. And then from there, that's basically what you show on the illustration. And on this one right here, if you want to just cover, if you don't take out any money the first year, it will carry over to what you can take out the second year, so forth.
Yeah, on this product, if you don't take any funds out on any given year, you can take out 20% the following year. So
Yeah.
a lot more liquidity, a lot more access, a lot more freedom. So it kind of takes away, because what you'll find out is a lot of advisors will give bad advice on these, not knowing what these products are and how they work. And they'll say you have no access to your money. And we're like, oh, contraire, mon frere. You can take out 10% per year or 20% or take the whole thing out after the fourth year if you want. And when you cover that, they're like, oh, this guy told me something that wasn't true, if they've already talked to somebody, an advisor, about what these products are.
Right. That's really good. And then, John, after that, then you basically were in this room and they're going, wow, this is really good. And I know this is when you told them, obviously it's not too good to be true. There's some surrender charges. So, we're looking at 4 years if we move the money over. Then you move over to, then I saw you talk about why now? Because, their mind is like,
Yeah.
okay, when do I want to do this? And
Yeah.
they asked you, John, no, so when should I do something like this? So
Yeah.
when you're in this phase, cover what you got, because I know that was super good too.
So like these people were serious planners. Like when we first met, they were talking about a house they're selling in 2 to 3 years. And then they had 3 accounts, and one of them said, well, what we're looking at doing is maybe moving one account now or a year from now the other one a year after that, and another one a year after that. And I had mentioned something about, well, now is a better opportunity. They said, well, why would it be better now? And I said, well, for a few different reasons. So the markets that are an all-time high, the stock markets, their 401ks, everything is doing better now than it ever has been. So it's at a peak. But the other thing that's also at a peak is the environment for fixed index annuities. The fixed index annuity products right now are stronger than they've ever been. And without going into too much detail about it, it's because the treasury yield has dropped significantly over the last 3 years. When that drops, the cost of options is a lot lower. So the insurance companies can buy higher participation rates and higher bonuses. When that treasury yield goes up, the cost of options goes up, and the participation rates and the bonuses will be lower. So why is now the perfect time to do it? Because your account's at a peak, and our products are stronger than ever. If you wait until say 2 years from now, if the market loses and the environment is less, over time, we're talking about retirement. We're talking about 30 years. Over time, you're going to lose a truckload of money by not taking advantage of those high participation rates and high interest rates that you can get right now.
And John, is that something that only happens like right now? Is that something that will change a year from now?
It can change. We've already seen some of the participation rates coming down over the last couple months, and the markets are starting to change a little bit. The Treasury lowered the Fed rate, and so that it works inversely. And so the Treasury yields climbed up a little bit, options got a little bit higher, and participation rates are a little bit less than they were 6 months ago.
Right. And then a good one that I remember you saying right there is like, but fortunately, guys, Athene is still giving us these
Yeah,
really high cap rates.
yeah,
And I'm not saying, that's possible forever. So it will change, and guys,
yeah.
it's the truth. I'm like, before it used to be, it was now it's participation rates. And before it was like caps, like, is it
They
13?
have both, but mostly participation rates. Yeah, yeah,
Yeah, but that was really good because now I'm like, you can see how guys, if you're getting your client to this phase, they're like, okay, I guess right now, even though the market's at an all-time high, it's almost contradictive because some people think like, oh, well, I shouldn't get into annuity because I won't get more gains, but it's like perfect time. And so that
yeah.
was really good. Do you have illustrations of other clients that you have? And what I'm going to do, John, is for this group specifically, because this video does go on YouTube and everything, but because I want to get people on this chat, I'm going to send them a copy. Like you said, you would, send, I think I have it already too,
Yeah.
but I'll send you this copy. And what's great is if you get a client to the end of it, this is how I would do it. I'd say, guys, I actually have a copy of one of the clients that we've been able to help out and the returns that they did. And we have their statement from last year. It's our client. You see, like John's helping me. It's one of his clients, but the statement doesn't have their name. It's just an example of literally what's happened last year with these. And so I would take advantage of this. Like, no, you're a part of this. If you reach out to John, he's going to reach out just like I do. So take advantage of everything you're getting on this call. I'm going to send you the same thing that John's sharing on the screen.
So, and I'm not great. I have stronger return ones, but this is just to show you how the high participation rates work and the bonus works. And so
And
this is
John,
actually one of my
tee it up
what's
like
that?
how you did with the clients. You said, I don't like believing in something that I haven't seen, or talking
Yeah,
to
okay.
people. Yeah.
So we can talk about the hypothetical all day long, but all that is a projection. What I have here is something that's real. It's real money. It's a real client, and it's real growth. So what I like to do is show what the possibilities are if the market performs at a certain rate, but also to show you that the numbers I provided in the illustration are not outlandish based off of the actual returns my clients are getting. And so I have something here that's an actual client of mine. Um, and if well, my number's on there. It's not too bad. I didn't know it was going on YouTube. Anyway, so here's a client of mine I met with. The funny part, and I'll tell you this because this is actually pretty funny. I met with this guy in person. His wife set the appointment. He would not come to the table, and he stood in the kitchen, said, "I want nothing to do with it. I don't know why he's here. I didn't set this appointment." And I said to him, I said, "Hey, I don't want to be here either, but your wife set the appointment, so I had to come." So if we can sit down at a table, listen to me for 5 minutes so I can go home, I'd really appreciate it. And so he walked in, he sat down with his arms closed, and I just started the slow drip and giving him a broad overview of how our products. Then his arms came uncrossed, and then we started talking, and then we ended up moving 300,000. Okay, so it just goes to show you that some people that want nothing to do with you, if you just stick with it long enough and just kind of slowly draw them out, you can actually help a lot of people if you don't give up too early. So this was
Yeah.
300,000 moved over. It had a premium bonus applied to it of 42,000. Total interest credit is 25,000. Now, if you look at the interest credit at 25,000 on a 340 or 300, yeah, $342,000 account, it's not outrageous, but I'm going to show you why it actually is quite a bit. So now their account value, here's that point. They actually have a rider charge to increase their participation rates. So they started with 300,000, and after 1 year, now they've got 362,000, and this is their baseline. It'll never go below that until they take withdrawals. So they're never going to lose any money in a down market. So now their baseline is 362,000. So how did we get here? So if you look at this, when we design these, we put half their funds into 1 year strategies, the other half in the 2 years. The 1 year strategy is going to capture those years where the market goes up or the market goes up and then goes back down the following year. The 2 year strategies are designed to capture those consecutive years of growth, higher participation rates, a little bit more bumps. When we looked at illustration, we looked at back at the last 10 years returns at 19.7. That's going to be on a 2 year strategy. Okay. And so this is interest on the first year. This is only interest on the first year that he had it in March of 2025. So 4 months from now, the markets are actually held. He's going to get a lot more interest applied, but this is only the first year on half of his money. So here you have the 1 year strategies, half of his funds. Here's how strong participation rates can impact an account. So one of his indexes went up 7.47%. The interest that was applied to his account was 16.8. So here it was 12% growth and 15% applied. So when we're talking, we're trying to show something that is 100% safe against market loss. We're giving him a good bonus. We're reducing or eliminating the fees that he has, and we get this kind of rate of return. Now, I'm not going to say this is the way that's going to be forever, every year. I'm just letting him know this is what's possible, because we had 2 years of losses, 21 and 22. We moved his money in 23. He's already losing money. The bonus that he got helped recapture some of those losses, and now he's getting these gains on top of that. So the environment was just right. The timing was just right. But the illustration that we show, this just validates that, saying, okay, we're showing an average rate of return of about 8% on that. This is how that happens because we have these high participation rates. We don't need a whole lot of growth to get that 8%. Half of his money on the 1 year strategies gained an average of 15% or 16%. So this is showing factually that this actually happened, because illustrations are great to show what it can do. This is showing what it did do. That
That's
makes
great.
sense? And then he's got the
Yeah.
other half. So when the other half gets applied, that 362,000 is going to grow to be a lot more than that, because he gets his 1 year interest again, because every year he gets the 1 year strategies, and on the 2 years he gets the higher participation rates. And so that 362,000 will probably, if everything stays where it is right now, be closer to 400 in a matter of just 2 years.
And John, do you help agents choose a participation rate, or how? Haley asked, are you using the same indexes that were in that illustration there? Haley, you can unmute
So
too.
what I do now is, because if you work with Athene and have them run the illustrations, they have preset allocations that you can spread it amongst all of them. And that way you're not hedging your bet on a certain index on whether it does or doesn't gain. You're spread out between everything. Some are going to perform in some years better than others, but overall you're going to get a pretty consistent gain.
Yeah, that makes sense. And now that was great, John. I mean, if you guys are watching this or like on repeat, I would continue to watch this on repeat. If you have an annuity appointment, I would just watch that last bit on repeat over and over again, because literally I would just say that on over, like in your own words, it's going to happen. The next step, they're going to say, well, how do I move it? Like, how much can I do? Like, and there is a way. So what do you say about that? Do your take, like, hey, John, so that's perfect. So how would I get my money in there?
Okay, so here's the thing, is like, we're so highly regulated that we just can't take everybody's money. It's got to go through suitability. And what suitability is making sure this is the right product for your situation, and that you have funds outside of this, so you're not going to have to run into a situation where you do have to pay those surrender charges. Because the insurance company doesn't want you to have to pay to access your money. So the suitability process is part of the application. We take the application. It takes about 12 to 15 minutes to get that information input. Then it goes through the suitability process. Once it goes through that process, then it gets approved, hopefully. And if once it gets approved, then we're ready to go, and then we're ready to transfer the money. And all that transferring is done. You don't have to do anything at all. The transfer form is part of the application. They will reach out to the seeding company. They'll send the transfer form over. The seeding company will send the money over to Athene, and then it issues from there. And here's the thing is I know this is a big decision. This is a retirement account. Typically they take 30, 40 years to build up. So we don't want to make any rash decisions. Going through suitability, make sure it's the right product for your situation and meets your goals. But also after it issues, we're going to bring the policy out to you or send it out to you, go over it together. And you have 30 days from that point on to get the policy in your hands to make sure that everything is true and accurate to what we went over today. And if there's anything that you're looking at, go, whoa, John, that's not the way you presented. That's not what I thought. You can actually reverse the whole thing with a phone call to them. It's never happened to me, but
Yeah.
you have that option. You have a 30-day free look period just to make sure to sit down while nobody else is around to go through all this thing and make sure it's exactly what you want. Does that sound fair?
Yeah, it's
Anymore.
good. You really become their friend on that. So then it's like, hey, I'm with you. Whatever you want to
Yeah.
do, let's do it. Now, John, a lot of people are probably excited and they're like, dang, dude, how do I find an annuity? How do I find an annuity? And I think they can all just dial the leads. They'll find the money. Now, let's just say you want to get after your warm market. You're brand new. Like,
Yeah.
how would you tell me? Let's do some role play a little bit. Because now I'm like, let's say I'm brand new and I'm like, okay, I kind of have a good idea. I'm trying to talk to the people that can hear this call and they're like, I think I could do what John is saying, but how do I like bring up the annuity and get like a friend that just is knowing I'm new to insurance. They're like, I think he's only doing this for 6 months. How would you help a
So
new agent get that connection to you?
so okay. So here's the thing. If you look like you're not asking a friend. Okay. You're asking a grandparent. Okay. Because your friends are not our clients. You're too young. Everybody on here all have young faces. You guys are not our clients. Our clients are people who are 50s, 60s, 70s, want to protect their money from market loss, kind of see retirement kind of at the light at the end of the tunnel, or maybe they're there, or maybe they're crossed over and they have an IRA. So if you look like Diego, look to see where your grandparents are, or possibly your parents, because he might look a lot younger than he is. And so you want to look at somebody who's in their 50s, somebody who looks like they went to high school with me, somebody that's in their 50s, somebody that might be in their 60s or possibly 70s, and just start that conversation up. And just, it depends on, how close you are, because some people don't want to, show private information. But just say, hey, I'm learning a lot about our retirement products. They sound really cool. They're probably the most popular type of retirement product out there where you can't lose any money. Now, I know you might have something put away. Is it okay if I ask you some questions, put together some information on the products that we have, and present it to you just so I can get a little bit of practice? There's so many people that start their annuity career off by helping out parents or grandparents because they start having that conversation, and you can have it in a non-threatening way that your grandma's not going to hang up on you. She's not going to walk out of the room from you. She's not going to not talk to you again. And so to start that conversation, a lot of times when you start showing them how strong our products are and what they can do for them, and say, hey, I know you've done good up to this point, but how much of this can you afford to lose if the markets were to turn? And you can do the same thing that Real says, is show them what it did in 2008. You can just ask them about it. How much did you lose in 2008? Most people that are retirement age, they act like it happened yesterday, and they act like they didn't get their money back. And that's perfectly okay because they're feeling that when you ask them. So if you meet with somebody that's a little bit older and say, hey, how much of that did you lose in 2008? Could you afford that now in your stage of life? Well, we have these retirement products. Do you mind if I just show you how these things work so I can get practice so I can help my clients?
So good. And like he said, guys, and you're not the expert. You're just doing inventory. You're doing inventory to figure out, you're starting to learn about what the power of these retirement vehicles. And now once they're interested, I mean, the easiest play, literally call me and say, hey, this guy would like to talk to John. Boom. Literally set up a time, starts with a phone call, you get a presentation. That's super, super valuable. If
And just
if
can I add something to that? If I'm helping your
Yeah,
grandma, I'm not going to take a cut. I'm just helping you help grandma. Okay. So that's on you. I'm not, if it's a client that
yeah,
you've gotten where it's a stranger and we're going to do that together, I'm not taking anything for grandma. I just want to help you guys out.
yeah. And guys, and as I've experienced it now with John and even with the other guys in the SRS team, like John said, and I'm trying to push you guys to go and work with them and just make it more of a transaction, like work with them, hit up John, get to John. But it is not really like he says, as you get him on the call. Once we did this here, right? The client was gone for 20 minutes. He was like, hey, let's close the door. What'd you guys get out of that? We're learning together because he wants to know what I got out of it because the goal would be hey John, I'm just asking you how I can help these 5 guys, so I'm teaching you guys how to do it. And I hope that this call is leading, helping us do that, because now we'll have it on repeat over and over again. Just with the last few minutes, I mean, this has been a super valuable call. I'm super excited about what it came out to be. Do you guys have any questions? I know some of you guys were excited about it, and we're trying to ask John questions. Did you guys have anything while John's here? Tell us.
I had a quick question. So you talk about after 4 years, they can pull out the whole thing. I was seeing on there, it looked like there were still surrender charges. How does that work?
So the surrender charges are if they wanted to take a withdrawal above the 10%. If they take the whole thing out, then they're activating the return to premium rider, which is completely different than taking out more than 10%. So the return to premium rider definition is in the illustration. Yeah.
Okay, so
that makes sense.
They can take out more than 10% after 4 years, or no? Sorry, I don't.
They after 4 years, if they take out more than 10% but less than 100, they're going to be hit with surrender charges. Okay, if they just take the whole thing out, it's called a return of premium rider. So they're taking the whole thing out, activating the return of premium rider, and taking their ball and going home. The surrender charge is only the amount if they take above 10% but less than 100.
Got it. Okay, that makes a lot of sense. Yeah. Okay, cool.
That's huge.
Good question,
yeah, thank you.
And so, John, you're saying if you get into the annuity space, it would be a thing to then have a book of business, like how we have our life book of business, and then you're wanting to help them after 4 or 5 years to say, hey, if you can get a better bonus, we put that rider in place for a reason.
Yeah, I've flipped a lot of restructured. I have to be careful with that because the environment is a lot better today. And the bonuses are bigger today. I've done a lot of internal replacements with Athene, because they have certain guidelines you got to abide by. And the bonuses are higher now than they were then. Back then it was 6 or 8%. And so they have the opportunity to get a more modernized product and not lose any money.
Yeah. That was great. Well, John, that was value packed. I feel like if we extend it, it's just going to get it over their heads. But dude, this has been insane. I literally, guys, if you guys need John's number, reach out to me. He's literally a helping hand. But if you did have one more question, reach out. I mean, we got I try to get it all the way to the 6 o'clock, but honestly, I just want to end it at value. John, I appreciate you. If you have any last words for us, I feel like we have literally action call. Like we know exactly what we got to do.
The biggest thing that you have to understand is we have a product that not too many other people can sell. You have to have your insurance license to sell it. We have a market that needs it. We have 10,000 people in the United States retiring every single day. They've done a poll, and 53% of those people don't think they have enough money to last a lifetime. The other 43% are probably wrong. So if we already have 5,300 people retiring in the U.S. every single day that don't think they have enough money to last their lifetime, they can't afford to lose any money at all. So we have the license, they have the need. We just need more people asking those questions, going out there, uncovering the money, and helping those people out. The people that write the most annuities are not necessarily the most knowledgeable about them. They're the most active in asking those questions, identifying the money, and helping the clients.
Huge. No, that's huge, guys. And honestly, the annuity that Pivo got, he's not our top producer. He literally door knocked the people downstairs, guys. And how much annuity money, if you think about it, she starts with 230 and she's got 3 homes, one sell and then the other, each one designed for an annuity down the road. It's like one.
And that's what they're looking at too. They're earmarking, when I get this 200 and I get this 600, they're talking about when I get this 600 from the sale of this other house. Yeah.
It changes an agent's life. So that's why, guys, the goal is to literally help a new agent, experienced agent, but we have experienced agents on here. And so I would say keep finding the money and implement the license that we have. If you're brand new, this will change your business because the payout on these is insane. You roll, it's 5%. Think about it, that's the low end. And I know as you get bigger commission, as you sell more, you get up to like 7, 8, 9, I think. And it's like I sold one for like 170, John. I was like, $7,000 in my account, and I'd split it.
And it's not charged back. It doesn't charge back. You get to keep it. Yeah.
It's a no-brainer. John, I appreciate you being with us.
Thanks for having me on, man.
You guys got it. Appreciate you. I appreciate all you guys for being here too. If you guys need anything, I'll see you guys over here.
Thank you, John.
Yep.
Thank you, John.
Thank you, John.
You betcha.